Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, my guest is Matt McCann. Matt is one of the nation's leading experts in long-term care and long-term care insurance. He's the founder and managing editor of LTCnews.com. He has an insurance business. He's licensed as representative to write from all the major policy underwriters in all 50 states. He's been around for a long time and really knows his stuff with regard to long-term care. He joins us on the show today to talk about the state of long-term care, both in the U.S. and around the world, how our aging demographics and retiring baby boomers are contributing to the increased need for long-term care services around the country. And he shares a lot about long-term care insurance, the structure of policies today, and where the opportunities might be to mitigate some of the costs for people like you and me down the road. We have a slightly different perspective, Matt coming from the insurance industry, me coming from the fee-only financial planning side, but it was really wonderful to talk to him because he is truly an expert in the nuances of policy and long-term care strategy. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Matt, welcome to the podcast. I appreciate you taking some of your time to be here.
Grant, great to be here.
Tell us a little bit about yourself and your working world. You were just sharing this with me. You have quite the journey throughout your career. You started in radio, sounds like, right?
I did. I had been doing radio professionally since age 15. Of course, they didn't know I was age 15 at the time, but, the facial hair kind of, this is 1975. And by the time they figured it out, it's like, yeah, all right, whatever. So I did radio most of my life, and in around 1998, with circumstances with my employer going on around the same time, my mom had a health event, and at age 59 ended up in a nursing home. I ended up doing long-term care insurance and entering the long-term care insurance industry, mind you, doing it temporarily. So I've been temporarily involved in long-term care insurance since 1998. I am now licensed in every state. I do exclusively long-term care insurance as far as my insurance firm goes, helping people plan for the financial costs and burdens of aging. And then a number of years ago, with a group that I headed, we put on a website, a consumer-based website called LTC News, LTCnews.com, which really is one of the few, if only, completely consumer-focused websites to help people understand the differences between Medicare and Medicaid, health issues, insurance, other ways to plan for long-term health care. So that keeps me busy as well, and it's really an interesting time to be in long-term care because most of us in a certain age group now have aging parents or already went through aging parents that have needed help with daily living activities or supervision due to cognitive impairment. And it's tough. It's tough financially. It's tough emotionally. The impact and the consequences are great. And without planning, it can be devastating.
Yeah, that's well put. I like the convenience of the career shift. You had this experience where you're having to figure all this stuff out as your mom is making that transition. You say, well, holy smokes, that might be applicable over here. Might as well give it a shot. And temporarily to, 22, 24 years later.
Yeah, but who's counting all those
rocks.
years? Yeah, no one's counting those years. What's interesting?
Well, you still look nice and young. I was going to insert some kind of face for radio joke in there somewhere, but you're such a good looking guy. We're doing video for those of you who can't who can't see us, it wouldn't be applicable.
Well, thank you for that. It's interesting. When I first started in this industry, the average age of someone investigating long-term healthcare planning was 68. So I was younger than all my clients. Today, the average age is about 53. So I used to be younger, and now a lot of my clients are younger. I'm not sure I like that trend, but it is what it is.
So why don't we start here? Could you share a little bit about just the landscape for long-term care that we're facing as a country? And what I'm thinking here in the back of my head is we've got this huge portion of our population comprised of baby boomers who are just starting to phase into the need for this kind of stuff. So where are we as a country, as a population, in terms of the large scale need for long-term care in the first place?
Well, I hate to be a talking head and talk about crisis because everything seems to be a crisis these days, but it's not just a crisis in the United States, it's a worldwide crisis because the world is aging. And in the last 20, 30 years, women are working outside the home. And not just obviously in the United States, this is a worldwide situation. And people end up declining both from a health standpoint and you know a physical standpoint from mobility problems to cognitive issues with Alzheimer's and dementia. And we're not prepared. We have never been prepared for the financial costs and burdens of aging, whether it's on a family level, a state level, or a national level. Health insurance or Medicare, which is health insurance for those 65 and older, we pay taxes for our working lives. It becomes our primary health insurance when we're 65, does not pay for long term health care. It pays for a limited amount of skilled care. The purpose of health insurance is to return us to a previous level of health, not to maintain us. Medicaid, aid is the medical welfare program. It was never designed for long term health care. However, it's become the primary payer of long term health care services in the United States. And that is placing huge strain, not just on family budgets, of course, who have to exhaust assets to virtually nothing in order to qualify for Medicaid, but state and federal budgets, which were never designed to do that. So we've seen a number of things happen. The state of Washington recently passed a tax. I call it the LTC tax. They call it Washington Cares because they care. And what they are doing, effective in 2023, is taxing individuals that do not own qualified long-term care policies based on 100% of earned income. So for people that actually have a lot of income, it can be a very expensive tax. And now we have California, New York, Illinois, Minnesota, and Michigan, which are getting close to instituting their LTC taxes. There's about a dozen states that are toying with the idea. Um, and the reason I think they're doing it, obviously, other than they need the money, is because many of us, including people who are older and need care, are in denial about the problem of long term health care. We have had carrots out there to encourage people to buy long term care insurance since the original HIPAA Act was signed by President Clinton back in 1996, that established tax qualified long term care insurance, that set in the consumer protections, the regulated benefit triggers, and the tax incentives. And of course, the partnership program was expanded in 2005 when President Bush signed the Deficit Reduction Act. And we have 45 states in the country that have active long term care partnership programs in place. Yet, when I do shows like this, or I do speeches around the country, or just talk to consumers one on one, they usually have no clue what the heck I'm talking about, including financial professionals. I'm going to put you on the spot, Grant. You may have done some homework, but are you familiar with the long term care partnership program?
No, I'm not.
Okay. And that is part of the problem. Most of us are not. What the partnership program provides is if you as an individual have a qualified long-term care insurance policy and ever exhaust the benefits from that policy, you're able to shelter part of your estate based on the total amount of benefits paid out by the policy and still qualify for Medicaid. So kind of think of it as a safety net that no matter what happens, you would never lose everything. So obviously, people under 1.5 million, this is really a great thing for them. People over that amount, probably not so much. But if you're sitting there in Des Moines, Iowa, you got your house, you got your 401k, maybe you saved 800,000, maybe you did a million. Okay. You can buy a relatively small long-term care policy. And no matter what happens to you or your spouse, you would never lose everything. Now, there's a lot of power in that because without insurance, as you know, Grant, there's only two solutions for long-term health care. You are either going to pay for care yourself out of your savings, your income, and then your family is going to make the arrangements and to decide how you're going to be taken care of, or your family will be the caregivers. And adult children are not prepared or trained to be full-time caregivers. And talk about the sandwich generation and the consequences of trying to, and usually a daughter or daughter-in-law, trying to juggle their career, their families, and their other responsibilities with that of being a caregiver. To say it's tough is an understatement. So that's the issue. But the biggest problem that we have, and it's not just in the United States, is the level of denial that this is an issue. So it doesn't matter what the facts are. Okay. The Department of Health and Human Resources says if you reach the age of 65, it's a flip of a coin. You have a 50-50 chance of needing help with activities of daily living or supervision. So if you went on an airplane and they told you, hey, we got a 50-50 chance of landing safely, would you stay on that airplane? Of course not. So it's either going to happen or it's not. You're either going to be prepared or not. But those decisions that you make now, before you get old, will have a dramatic impact on your family and your finances. And that's what requires planning. And you have to understand that there's a problem in order to understand there's a plan to solve that problem.
Right, right. Why 1.5 million? Why the threshold of 1.5
Well,
million?
because if the policy pays 500,000 and you've got a lot more than that, you still have to spend down savings to get to the amount of money the policy paid out to get to the shelter amount. Okay. So if you've got a couple $1,000,000, will you ever exhaust all your benefits? And if you do, you'd still have to spend down to whatever the policy paid out in the first place. Not that that can't happen. Some of the biggest claims that are still being paid by insurance companies are now nearing the $2 million range. But, those are few and far between, what I call the Ronald Reagan situations. They happen, but that's unusual. And if it does, you still have a significant spend down to get to the point of the shelter. But for people in mid-America and upper middle income who have a lot of savings, and of course, to me, $400,000 is a lot of savings. To someone else, 1.2 million may be a lot of savings. Whatever that number is, you don't want to lose it. And if you have a partnership long-term care policy, you're able to shelter it no matter what with a relatively affordable plan, as opposed to over-insuring and buying more insurance than what someone realistically really needs.
And can you describe what you mean by shelter? I assume what you're talking about is if somebody has $500,000 to their name and they've got a long-term care insurance policy that will provide a total of $250,000 of benefits, that once the policy pays out that $250,000, they're not going to have to spend down the money that they have remaining in order to qualify for Medicaid benefits. Whereas if you don't have that in place, Medicaid will kick in benefits, but you have to spend through most of your assets. Is that a fair
Absolutely.
description?
So, yeah, kind of close. So let's say you have a policy and you start with an initial benefit pool of, let's say, 250,000. Now, that's going to grow with inflation. So by the time you need care, you might have $500,000, $600,000, $700,000 of benefits. As the policy pays out, the remaining benefits are still growing. So we don't know what that amount will be if you end up exhausting it. But once you do exhaust whatever the policy pays out, it's referred to as asset disregard. So the government will disregard an equal amount in calculating Medicaid. So normally in most states, you have to spend down to $2,000. There's some states that are a little bit different, but they're in the ball game of $2,000. You get to keep the $2,000. But if your policy paid out $575,000, you get to keep $575 plus the $2, and that is the shelter amount. So if you have more than that, once you get to that total, you can now qualify for Medicaid's long-term care benefit without being poor.
Right. Thanks for the description. So, long-term care insurance has gotten a really bad reputation over the years. And personally, I'm of the opinion that people will generally, I'm putting my financial planner hat on now, fit into three categories. Number one, you're wealthy enough to be able to afford help with activities of daily living, a stay in an assisted living or memory care facility out of pocket, to where that's not going to jeopardize your financial independence. It's not going to jeopardize your financial objectives. You can still leave a nice bequest to the kids or charity. Whatever stuff you're trying to do, you can pay for it out of pocket. And in that scenario, I'm very reluctant to recommend a long-term care insurance policy. And on the other end of the coin, people who are damn near destitute in the first place, you mentioned a 50-50 coin flip if you're 65 as far as whether you need services or not. Well, if the premiums of one of these things are going to make you destitute in the first place, I'd much rather take the coin flip than know that that paying the premiums out of pocket are an unaffordable thing. But it's the people in between those two extremes, in my opinion, that could be a good candidate for a policy. Over
So
the years, there are a huge number of awfully negative headlines about premium increases, and I suspect that that's because the life insurance underwriters who created the products years ago just mispriced them, and I know there have been some improvements in this area. Could you enlighten us on this a little bit?
All right, so let's take one at a time. Let's take the people. Most people with long-term care insurance have money. This is not a product for people that don't have savings. You don't need it. Even if you could afford it, and by the way, premiums are actually very affordable, and we'll get into that part here in a moment. But if you don't have savings to protect, this is not a product you need. You do not need long-term care insurance. End of story.
Mm-hmm.
Let's take the other extreme. I have quite a few people you would know by name, that have a lot of money that have long-term care insurance. And as one fairly wealthy CEO who is a client of mine told me, he goes, Matt, I spend $2,200 or more on a weekend of golf. So $2,200 a year to make this your problem instead of mine is a pretty good bet. And I think that's the attitude. Yes, it's a financial problem, but it's also a family problem. So let's pretend, Grant, that you're one of those people. You now have, congratulations, $15 million. You have a couple of houses worth a few million. You're doing pretty well for yourself. Congratulations. You deserve it. You could self-insure. And you're not really self-insuring. You're self-funding. If you need care, you will not be writing the check. You will not be making the decisions. Someone else will. Someone will have to decide which account to liquidate, how your plan of care will be delivered, and deal with the emotional part of having usually dad, in your case, because you have kids, and it's usually the adult children making these decisions. They have to deal with the emotion of having dad need care, or mom, of course, but we're dealing with you now, Grant. So it's you needing care. Now, we don't know when you will need care. And as a financial advisor yourself, you know you cannot time the market. So if your need for care happens when the market is down, your family will be liquidating assets at a quote unquote loss. Now, that loss still may be a taxable gain. So then you have the tax consequences of that. And as you liquidate money, creates income, it can impact the cost of your Medicare. It's a snowball effect. So not only are you using all your money to pay for care, it's going to cost you more. It doesn't relieve the burden on the family because the family is going to still have to make that plan of care. Whereas if you're, 50 years old and as a healthy male, you might be able to get a really good policy for $2,000 a year or sometimes less. By the time you need care, you have hundreds and hundreds and hundreds of thousands of tax-free benefits, case management, and other services to pay for your care, and your family has time to be family. Now, you get a choice, Grant. Which choice are you going to make?
I'm not putting it in the policy.
And that's fine.
Respectfully, I'm not putting it in the policy.
And that's fine. But if your premium is $2,000 a year, okay, and let's say you're 50 years old and you need care by the time you're 75. I mean, you do the math. You're the financial advisor. I'm not. You now have, depending on the benefits, you probably have 6, 7, 800,000 or more in tax-free long-term care benefits, case management, and other services. Plus, since you're probably self-employed, you're taking the tax deduction on the premium as a business expense. That is a solution that a lot of people that I talk to say, yeah, that makes sense. But your group that I just described, they have a choice. They're probably not going to go broke because of long-term care, right? But now let's change you to you have $700,000 in your 401k. Okay? You've done pretty well for yourself. A long-term care event can be catastrophic. It's still going to place that same burden on your family, but from a financial standpoint, it's going to be the consequences on lifestyle and legacy, and your spouse, who may still live another 5, 10, 15, sometimes 20 years beyond that, can really change their quality of life for the rest of their life. So we're in agreement, that group, that is the group that really needs long-term care insurance. The wealthy group, it's a choice. Do you want to use tax-free money, have a plan of care, and relieve the burden on the family? If you're a business owner, you have the tax deduction. Your choice, whatever. But the people in the middle, which is most of us, that's where it can be really complicated. The people who have little savings, no, they don't need to be spending, even if I get the premium down really low. And sometimes they want it because they know the consequences on their family. It is not appropriate for them. It is not suitable for those people. But the rest of us, most of the people that are probably listening to this podcast or watching it on YouTube or wherever it's available, those are the people that can really benefit and kind of reduce the physical, emotional, and financial burdens that are otherwise placed directly on the family.
Yeah, I think we're in agreement there, Matt, and I don't disagree with anything you said. I don't mean for this to be adversarial whatsoever.
Oh no, not at all.
Yeah,
It's a good conversation. That's how people
I agree.
learn.
This is exactly. I'm really happy that we're having it for that exact reason. I would argue that the threshold to be able to self-insure for most people is much lower than 15 million bucks. And I know that was just a hypothetical example, and it just totally depends on your spending and all the other personal details. But what happens when you put the $2,000 a year into the policy and then you're of the 50% who don't wind up needing care?
Well, and
How
the
are
other
these
side of
policies
that, of course,
structured these
is
days
you
today?
right.
I genuinely don't know.
Yeah, well,
But
we there's some insurance that we pay without thinking. I mean, you have homeowners insurance, we have auto insurance. The risk of having a totaling your vehicle is statistically small. Of course, we don't have choice. We don't have choice with auto insurance. If you have a loan, you don't have choice with homeowners insurance, right? We have to have those insurances. We don't have a choice. In the state of Washington and a dozen other states, they're going to tell you, wait a second, if you don't buy long-term care insurance and have it in place, we're going to tax you.
yeah,
So, some of those taxes, depending on your income, are substantially higher than any insurance policy ever will be. But that's, of
sure.
course, a totally different ball to juggle and conversation.
Sure, sure. So update us on the landscape of what policies look like these days. Like I mentioned, there were some bad headlines here years ago about policyholders paying into these things for years and years and years, and then premiums doubled on them, and then
Well,
premiums went
yeah,
up
let's take a look
50%
at that.
again the next year.
Those were the old legacy products that were sold prior to rate stability rules, which are now in force, and prior to the interest rate crash. So back in the old days, there was very little regulation, and they had very little research in underwriting. And the problem is the actuaries, and if you've ever met an actuary, they are the smartest people in the room. And they will tell you that they are the smartest people in the room. No offense to actuaries, I've told that to you, and then they'll sit there and well, of course that's true.
I make fun of
Um,
actuaries too. Smartest people in the room, least fun people to have a beer with.
oh my goodness, I could tell you a story. I did a speech somewhere, and after we went to the lunch, and I sat at a table with a bunch of actuaries, and it was the most boring 45 minutes I've ever spent. But that's another conversation. Very nice human beings. It was really boring. They're sitting there doodling. It's really actuaries have a mind that I can't even imagine. But so in the old days, there was very little regulation, and companies could price it any way they want, but they thought the lapse rates would be high. Why did they think that? Because they know all the other insurance they sold. They know people don't hang on to it in high numbers. Um,
Life insurance lapse rates were high. I mean, what else do
yeah,
you have to go off of? Yeah,
I mean, J.C. Penney used to sell long-term care insurance. The retailer, the only other insurance they sold was like Credit Life. Most people dropped those policies. They thought the same thing with long-term care. That's what they thought. Then they thought people would die. So high death, high lapse, easy money. Well, guess what? The lapse rates for long-term care insurance are next to zero. No one lapses these things.
the older you
Um,
get, the more likely you are to need it. So why
bingo.
the hell would you ever let it go?
You
Yeah,
don't let it go. They were wrong on the underwriting. They didn't have any experience. They were using other types of experience to apply to long-term care. That was wrong. And they were presuming interest rates would never crash because they've never crashed in the history of the planet. Well, guess what? Interest rates crashed. So you had a perfect storm. So, yes, those old legacy products have had rate increases. But let's take a look at some of those, for example. All right. So I bought a policy in 1998, unlimited benefits, 5% compound inflation. My premium's 400 and some dollars a year. Okay. So if they double my premium, it's still nothing. So it's all relative to what you started with. Obviously, if you sat and budgeted for X, you're not happy if you get Y. And it doesn't matter how an individual understands the problem, they're not happy. But today, everything is priced based on the extreme low interest rate environment. Underwriting is scientific, and the regulation is extremely high. So what happens is an insurance company must first go to the Department of Insurance in order to even be allowed to sell a product. And they have to certify that based on their product design, underwriting, actuarial data, and pricing, that they expect, not guarantee, but they expect the premiums to remain level for the life of the product series. In the event they need to have a rate increase in the future, the insurance company has to go to the Department of Insurance. They have to prove a substantial need based on actuarial reasons. It is illegal to price profit. It has to go to an entire class of people. So they can't pick on you, Grant, individually.
Yeah.
Then the head actuary has to explain to the Department of Insurance why they messed up in the first place. So we haven't had rate increases on today's long-term care insurance policies, unlike the old legacy products. The Society of Actuaries did a study. They said the chance of future increases on today's products is nil, not zero, but nil. And if there is an increase, the chance would be in the neighborhood of 10%. So today's risk is different than yesterday's headlines. Now, there are, if you have a situation where you're really, really concerned about a premium increase, you can buy a product that's impossible. And those are what we call hybrid. These are asset-based policies that combine life insurance or annuities with a qualified rider for long-term care. A couple of things that a consumer needs to be careful with, however. First, they are not partnership certified, so there's no additional dollar-for-dollar asset protection. You have more limited tax benefits because they're typically paid with a single premium. Now, if you're a C Corp, that's a different story, but otherwise, you lose some of those tax benefits that you get a bigger bang with traditional. And they're expensive, okay? They're not cheap because you're going to get money one way or the other. Either someone's going to get a death benefit, not you, you're dead, or you're going to need long-term care and you're going to get that money, but you need long-term care. But you will never get a rate increase. It's impossible. So there are ways to avoid that if that is a concern for an individual. But usually that's not the best use of money. Most people I talk to already have life insurance in place. Their need for life insurance is more limited. There are situations where it is appropriate. And, we'll probably be getting into the weeds, but, that there are situations where a hybrid is absolutely the best option, either because of an underwriting situation or because you have a lot of cash value in an existing life insurance policy or an annuity and you're doing a tax-free exchange. So it's really not costing you anything. But for most people who buy long-term care insurance who are in their 40s and 50s, usually that is not the best use of money, and the risk of rate increases, it's minimal. Now, for those that are having a rate increase with those older legacy products, most of them usually don't end up paying any rate increase. They usually reduce the inflation benefit, or they reduce other benefits to keep the premium the same. And what we have found is a lot of those policies have grown so much because they were growing with 5% compound inflation, which was certainly higher than the actual increases in the cost of long-term health care. We could safely reduce the benefit one way or the other. They still maintain coverage. They're not paying any more money. So if you're one of those individuals that have one of those older legacy products, you need to talk to a specialist who can advise you. Don't depend on the insurance company to give you options, because typically the options being provided by the insurance company benefit the insurance company more than they do the consumer.
Yeah, absolutely. So tell us more about the tax-free exchanges. And I've run into this a number of times over the last couple of years. Somebody who's been putting money into a permanent life insurance product for a little while. Now maybe their wealth has gone up and they don't necessarily need life insurance anymore. This is definitely an area where I've recommended a tax-free exchange into a long-term care policy that they could certainly have a need for in the future. Tell us about how that works and what the options are there.
Yeah, so let's say you have $70,000 of cash value in a life insurance policy. What you do is you basically do what they call a tax-free exchange. So we would move it into a tax-qualified hybrid policy. So it's what they call like to like. So if it's a life insurance policy, you have to go into a life insurance policy. If it's an annuity, you go into an annuity. But there's only a handful that are tax-qualified long-term care policies that meet guidelines under Section 7702B of U.S. Code. If you do that, that cash value will now provide you with the tax-free long-term care benefit, and then you still have a death benefit in the knock on wood event that you never need long-term health care. You haven't written a check. All you've done is moved from A to B. Now, there's not a lot of people with enough cash value in a life insurance policy to make that meaningful, but there are people that maybe got a whole life policy when they were in college and kept paying the premiums, and it's done really well. Or the same thing, they bought an annuity, it's grown. They find out they really don't need the annuity for income, and it's a way to solve the problem with long-term care without actually writing the check. So that's certainly something to talk to a financial advisor or a long-term care specialist. Um, Obviously, there's underwriting. Every insurance company has their own underwriting criteria, and so you want to be careful that you pick the right company matching your age and health. So if you're in that situation, then that 1035 tax-free exchange is an ideal solution, and you're not writing a premium. You're not writing that check. It's just going from product A to product B.
Yeah, I mean, it solves a couple different problems from my perspective. If you're in that situation, you have 70,000 in the permanent life insurance product, and maybe you've paid $40,000 of total premiums into it. Then if you were to surrender the policy and take the cash out, you've got $30,000 of income you have to capture as a result of that distribution. You can avoid that and, maybe check a box for your long-term care going forward by swapping it out via Section 1035, as you mentioned, into one of these products, which is a really nice, useful section of the code to use to your benefit.
Right, and by the way, you actually can do that. There is into traditional long-term care insurance as well. There's one company that will take a 1035 exchange. Um, Technically, under the law, all of them can. Most of the insurance companies don't want to bother with the necessary paperwork. So there are a variety of options for people, but they need to talk to someone who really understands that and can advise them properly.
Yeah, yeah. So tell us about how all this works in a business setting. You mentioned that you can set up one of these policies as a deductible business expense, accumulate value within the policy to use tax-free for your future long-term care needs. Can we get into the specifics of how the mechanics of all that from a tax
Sure.
perspective?
So with a tax qualified long term care policy, it's got to be a tax qualified plan that meets guidelines under Section 7702B of US Code. A business, whether you're a sole proprietor, okay, whether you're an LLC, S Corp, or C Corp, um, if you buy a long term care policy, it would become a tax deductible business expense. C Corps can deduct the premium 100%. Okay, and you can discriminate with long term care insurance. That means I'm a business owner, I have 10 employees, I can buy my long term care policy, I can buy one for my wife. I don't have to offer it to you, Grant. I know you're a great employee, but I don't even have to let you know that I have it. Okay. Which
Does
is
wife have to
unique.
be on the payroll?
No, have to be married, but doesn't have to be on the payroll.
Cool.
So the premium is tax deductible. The IRS publishes a code or a chart every year based on age. And so where you fall will be the maximum amount that is allowable each year. That's available at various places on the internet, including, of course, ltcnews.com, which has that. And so as you get older, the amount of money that is allowed to be deductible increases. It kind of matches, and again, cost of care varies, so policy size varies depending on location. But for the most part, it's a pretty good deduction. You're going to get most, if not all, of your premium as a tax deductible business expense. It is also not a taxable event for the employee. It's not going to be taxed on an individual basis, and the proceeds are tax free. Now, as I think you probably say at the beginning of your show, seek a professional tax advisor. We're not trying to give tax advice, but I do it myself. I'm an S corp. I have a lot of clients who own businesses that do that. Obviously, the C corp is the most ideal because you can deduct whatever the premium is. Okay. It doesn't matter the size. Otherwise, you have to look at the IRS chart based on age. But proceeds always remain tax-free, even if the premium was tax deductible. The other thing that people can do, if you have a health savings account, an HSA, you can use the pre-tax money in your HSA to reimburse yourself the cost of the premium. You cannot do both a tax deduction and use pre-tax money. But no, they will not allow that. Now, don't confuse an HSA with flexible accounts that a lot of employees have. Those are use it or lose it accounts. They're not health savings accounts. But health savings accounts work with the higher deductible health insurance plans that are in vogue right now with many employers. So there are a number of tax advantages for people to utilize where they can plan for long-term care, either take a tax deduction or use pre-tax money. There are some companies that, even on the traditional side, where you can pay off the policy in 10 years. If you don't want a premium when you're retired, but your cash flow is such, well, yeah, I can pay a little bit higher premium for 10 years. You can do that on the traditional side. Obviously, the hybrids can be paid with a single premium or 5, 10, 20, or on an annual basis. There's a number of ways to do it. But I think, and you alluded to this earlier, that a lot of people think long-term care insurance is expensive. And if I believe the stuff that I read on the internet, I would say the same thing. The reality is most people that I talk to look at it and say, geez, I was thinking that monthly premium, that annual premium was going to be the monthly premium. Okay. Long-term care insurance is custom designed. And generally my philosophy, and a lot of other specialists like me, our philosophy is to take a catastrophic situation and make it manageable. In other words, you don't need to overinsure. We know that you're going to have some kind of income coming in when you retire, be it Social Security, maybe you have a defined pension, you're going to have earnings off investments. The idea here is to have enough money coming in, tax-free money coming in, to give you choice of quality care in the setting that you desire without placing an undue burden on your spouse or the rest of the family, either physically, emotionally, or financially. So you don't have to, the cost of care is X. You don't have to have X benefit in your policy. You can if you want to, but usually that would be overinsuring. The other thing is most financial advisors and general insurance agents solve for nursing home. Nursing homes are the least used type of long-term health care.
Right.
Most long-term health care is delivered at home, adult daycare, and assisted living. Those costs, while not cheap, is a lot less than a nursing home. And besides, who wants to be in a nursing home anyhow? And if you are in a nursing home, chances are you're a woman. Go into a nursing home, it's like 8.2 to every 10 people are women. A lot of them are on Medicaid, but that's a different story. And if you're a woman in a nursing home, where's your husband? Probably not
Probably
around.
gone.
Okay.
Probably gone.
So the house can be sold. Those expenses disappear. So we don't have to worry about the little bit added cost to the nursing home. So solving for the least likely, although most expensive risk, usually doesn't make sense. The big issue is let's get quality care at home or adult daycare, which helps you stay at home longer. Or if you're going to go into a facility, assisted living, which is a lot less institutional, couples can stay together even if one is perfectly healthy. And you design a plan appropriately. And if you're buying a policy in your 40s and 50s and you're in good health, um, you can get a really affordable policy. Now, you got to be careful. Premiums can vary over 100% between insurance companies. So
Yeah.
you need to talk to someone who represents, all of them can kind of look and design it properly. But most people I talk to go, geez, had I known it was this affordable, I would have done it years ago.
Sure, sure. I really like the way that you put that earlier, and that we're trying to make catastrophic situations manageable. That's exactly how I think about it too. We need to, what is the worst possible thing that could happen to us financially, and make sure that if that unlikely event happens, that everybody else in the family and yourself are going to be okay, and your important intentions and objectives are still going to be met with the resources that you have, either through insurance or risk management or self-insuring or some combination of the two. I thought that was very well put.
The thing to remember, Grant, is it's certainly um, long-term care is certainly a financial problem. It's a cash flow problem. We want to address the cash flow problem. But long-term care is also a family problem. And this is the part that a lot of people in our industry don't understand. They may understand the numbers. They don't understand the family consequences. Unless you've been a caregiver for mom or dad or have been around someone who has and see them decline and understand the emotional impact in addition to the physical impact of being a caregiver. That's part of the equation. So when I talk to people, their concerns are first and foremost, they don't want to be a burden on their family. They want their family to have time to be family as opposed to having to be a caregiver. They're certainly concerned about cash flow, lifestyle, and in some cases, legacy. Some couples, they say, oh, if we die with nothing else left, that's fine. But most people want to leave, if there's anything left over, to go to children and grandchildren. They may not want to go out of their way to do that, but they'd rather have something than nothing. And a long-term care specialist or financial advisor that understands long-term healthcare planning can design a plan to address both concerns without overinsuring or making that burden of writing a check too difficult. And that is the challenge. And the other thing that I think is important to understand is every insurance company has its own underwriting criteria. So your health is really the only thing that gives you the ability to plan. You can have all the money in the world, but if you have bad health, it doesn't matter. No one's going to
Yeah.
give you an insurance policy. Insurance involves if. If there is no if, you can't get a policy. I mean, think of it this way. If your house is on fire and you call State Farm and you say, hey, State Farm, I want homeowners insurance. Can you sell it to me? By the way, ignore the flames out of my house. What is State Farm going to say? They're going to say, well, Grant, when you rebuild, give us a call and we'll talk then. Because how much would they have to charge you to give you a policy to immediately turn around and rebuild your house? They'd have to charge you more than what it's going to cost, right? So there has to be an if. A lot of times, unfortunately, I get contacted by people in their 60s, 70s, sometimes even older, wanting to buy long-term care insurance. And they or their families or both become devastated that I can't help you. Well,
Yeah.
I need it. I understand that. But I wish you'd have called me 20 years before. So this is something that you have to do as part of retirement planning when you can maximize your good health, also maximize the fact that the premiums are obviously much lower at 55 than they would be at 65 or 75, even if you are in good health at 75.
Right. Right. Absolutely. So let's say you're in a position, and I was speaking with a friend of mine just earlier this week who's in this position. Parents are in their 70s and 80s, declining health. They have a couple $100,000 to their name. And I'm a little murky on the specific Medicaid eligibility rules, but isn't there some protection to where, if one spouse really needs help through Medicaid, they're not going to require the other spouse to sell the house basically and become destitute, right? If you're
Correct.
in this situation where you have two living parents who are declining, they're not in good health, would not qualify to pick up a policy. What are your options? What do you do?
Well, there's a couple things. First off, there is something called a Medicaid compliant annuity. I am not an expert in that. There are lawyers that understand, and I can refer people, and you probably have your own people that you could also refer people to, that could help. The other thing is, uh, if home care is a legitimate option, there are reverse mortgages that can get rid of the mortgage and provide funds for home care. But that won't work if someone's needing a facility. So again, you have to talk to not just someone who does mortgages, but someone who understands long-term care, and to see whether that might be appropriate. The government will never kick out a healthy spouse out of their home. Um, Now, at the end, they're going to recover in estate recovery their money. Okay, but the other spouse will not be kicked out. So that I think is also important. There are services within the communities, depending on where you live, whether it's Meals on Wheels and some other services that are available. Many states have expanded Medicaid where there is some home care. Quality is a little bit questionable because, again, Medicaid reimbursements are unfortunately very low. So, whether it be a Medicaid facility or Medicaid home care, other types of care in the community, if it's Medicaid, just understand, the quality of care primarily not because of the people providing the care, but at the patient ratio to staff in a facility is such that it's tough. And for home care is not easy. So if you're not paying very well, the people that will accept that wage may not be as trained or experienced as you would like either. So that's why planning ahead is obviously ideal. But
Yeah.
like you mentioned, if the crisis is now, there's no chance for advanced planning. It's already too late. What can the family do? So there's always some services that will help the family. Most counties have some resources to help families in those types of situations, make recommendations. So there are things to do, but none of them are obviously ideal.
Yeah.
But keep in mind, the person that needs care is going to get care one way or the other. It's
Yeah.
the consequences after that we have to be concerned about. Quality care is always going to be an issue. Sometimes adult children will say, I'd rather quit my job, take a furlough, and be a caregiver than put my mom or dad into that. And people will make sacrifices as appropriate in those types of situations, which again is why we want to try to avoid that in the first place. But okay,
Yeah.
we can't go back in time. So you do what you have to do. And there are some resources to make it a little bit easier on everyone.
Aren't there resources out there too? I've heard of um, objective liaisons, or maybe like a social worker kind of person that you can bring in and maybe hire by the hour or something, just to kind of explain the landscape and what the options are and what the specifics are, county to county, area to
Yeah,
area. Is that a
many
thing?
counties have that service that is provided. There are private case managers that are available. Long-term care insurance actually has most long-term care insurance has
Yeah, the
professional
case
case
managers.
management
Yeah.
as well. Many home health agencies provide case management. So let's say you're taking care of mom, but you can't handle the whole thing yourself. So the family's kind of kicking in for some professionals to come in to basically provide respite for the family. Many home health agencies have professional case management that will help say, all right, this is the plan of care. This is how we can schedule it. On this day, maybe we send mom or dad to adult daycare. There are a lot of people, primarily because we're living in an aging society, that can provide resources even when you're in the crisis. And while it may not be ideal, there is help. You just have to ask for it. And that is one of the things that I find, even people with long-term care insurance, they don't ask for the help. I just got a call today from a family processing a claim. And in that conversation, we found out that for the last 7 months, the daughter was providing the care. So the question is, well, why didn't you call 7 months ago? And the response, which I hear often, well, we wanted to save the policy for a rainy day. So I'm thinking to myself, it was pouring 7 months ago. Okay.
Yeah.
But we might run out of benefits. You're probably not going to run out of benefits. And even if you did, you're that far ahead of the game. So if you have a long-term care policy or your mom and dad has a long-term care policy and they need help, there is no good reason not to access those benefits. Because most policies have respite care, have case management, have a lot of different services to pay for ramps, chairlifts, braces on your shower, medical alert systems. It's there. That's why you paid the premium, or they paid the premium. Use it. Don't wait for the rainy day. Understand that it's raining now.
Yeah. That's well put, Matt. So share with us. You've got a couple websites that you maintain. Tell us a little bit about what your presence looks like these days and where people can find you if they need more information on this stuff.
Well, as I mentioned, I run two businesses. One is a long-term care specialist. I'm licensed in every state and the District of Columbia. I represent all the top companies, and you can reach me at radioltc.com. That will directly take you to my website. It's a lot easier than spelling MCCANN. So just go to radioltc.com. As far as LTC News, we put that up. I have a staff for that. It is primarily a news and research resource website. We make money primarily from advertising. And the entire world's gone internet, and there you go. But it is a great resource for people either in crisis. Okay, mom or dad needs care now. What are you going to do? We're about to debut the country's largest directory of care providers, whether it be home care, adult daycare, assisted living, rehab, memory care, and nursing home.
Awesome.
There are stories and articles about caregiving, health, retirement planning, long-term care planning, that sort of thing. And that's at ltcnews.com. We also have a great cost of care calculator that's available under the resource section that breaks it down on the local level in every state nationwide, which is great from a planning standpoint, as well as, gee, my mom's declining. How much is this going to cost? And is the cost they're quoting me kind of close to what this average cost is? So there's always negotiation that can be done, and having some resources there to negotiate will be helpful. So that website is a great tool no matter what situation you're in, at ltcnews.com. It also has all the tax information and each state's specific information with the cost of care calculator. You can break it down from there. So those are great places. And whether you contact me or someone else, just make sure that they understand long-term care and not just work for one company and sold two policies in their lifetime. I process more claims than most agents or advisors sell policies in their career. And there's other people like me out there. We often work with people like yourself, financial advisors, both fee only and commission type, helping their clients. So there's a number of ways that we can help either consumers. We even on LTC News help people get in contact to get free resources to process a claim. Because a lot of times you might buy a policy and that agent is now selling shoes or something, they're not around. So
Right.
there's a lot of those situations, and you need expert advice and assistance. So those are the places to go to.
Right on. Well, thanks so much, Matt. I really enjoyed this. I think there are a lot of fee-only advisors like myself that have kind of a tertiary grasp of what the landscape looks like these days, and it's great to talk to experts like yourself that are intimately involved. Because if there are any takeaways here, I don't think that you want to dabble in this kind of thing. I think you want somebody that has an intimate knowledge of current product offerings across all the underwriters to make sure that people are getting into the best product for their situation. So
Absolutely.
thanks so much.
Thank you, Grant.
ltcnews.com, and we'll link to it all in the show notes.
Fantastic. Thank you, Grant. Been fun.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.